When a government announces large-scale infrastructure spending, ports, power plants, highways, railway corridors, logistical hubs, the immediate surface-level narrative is growth. Aggregate demand rises, employment increases, contractors receive tenders, cement and steel production accelerates, and headline numbers of GDP improves. This is the visible layer. Most observers stop here. That is a mistake. The deeper question is whether GDP rises in the short run, but whether the structure of that growth strengthens or weakens currency over time. Currency valuation is not sentimental, it is a judgment passed by markets on the future productive capacity, fiscal discipline, and the external balance of a state. Infrastructure spending affects a currency through multiple channels simultaneously. Some strengthen it, some weaken it. The net outcome depends on which forces dominate on the institutional components of the state executing the policy. To assume that infrastructure spending automatically devalues a currency because money supply increases is an oversimplification that ignores how modern monetary systems actually operate and how foreign exchange markets price risk and return. At the most basic level, infrastructure spending rises aggregate demand. Government expenditure enters GDP directly. Wages are paid, materials are purchased, services are contracted. In a closed economy model, this would be the end of the story. In reality, economies are open. Infrastructure projects are import intensive, especially in developing or middle income countries. Heavy machinery, turbines, semiconductors, specialized steel, oil, coal, LNG, and engineering services are often sourced from abroad. This immediately raises demand for foreign currency. Imports rise faster than exports in the early phase of infrastructure expansion. This puts downward pressure on the domestic currency through the current account. This is the first point that weak states fail. This is the first point where weak states fail. They initiate infrastructure booms without preparing the external sector to absorb the shock. The result is widening trade deficit, increased reliance on capital inflows, and vulnerability to global financial conditions. If foreign capital slows or reverse, the currency depreciates sharply. This is not because the infrastructure spending is inherently bad, but because it is sequenced poorly and financed recklessly. The financing method matters more than the spending itself. Governments have four broad ways to fund infrastructure: taxation, domestic borrowing, external borrowing, and monetary expansion. Each has different currency implications. Tax funded infrastructure is the least destabilizing but politically costly. It withdraws purchasing power from the private sector to relocate it towards public investment. There is no automatic increase in money supply and currency impact is limited. Strong states prefer this route, rarely rely on exclusivity. Domestic borrowing, typically through government bonds purchased by banks, institutions, investors, doesn't automatically increase the money supply. It relocates existing savings. The effect on the currency depends on scale and credibility. If deficits are moderate, the state has a reputation for discipline. Markets tolerate it. If deficits balloon, debt dynamics appears unsustainable. Risk premia rise, capital outflows accelerate, and the currency weakens. External borrowing is where many states destroy themselves. Borrowing in foreign currency creates a structural mismatch. Revenues are earned in domestic currency, liabilities are denominated in dollars or euros. If domestic currency depreciates, the real burden of debt explodes. Servicing costs rises without any increase in production capacity. This is the path taken by serious defaulters. Infrastructure funded by foreign debt doesn't strengthen a currency unless the projects generate export revenue sufficient to cover the foreign exchange obligations. Most do not. The result is predictable: depreciation, reserve depletion, and eventual crisis. Monetary expansion, often misleading called printing money, is the most misunderstood channel. Modern government rarely print physical cash to fund spending. Instead, central bank purchase government bonds, injecting liquidity into the system. This increases the monetary base, but not all increase in base money translate into inflation or currency depreciation. The effect depends on whether the increase in money supply is matched by an increase in real output and whether excess liquidity is later withdrawn. During periods of underutilized capacity, money creation can coexist with stable currencies. During periods of structural weakness, it accelerates collapse. The critical distinction is between spending that creates productive assets and spending that creates consumption without return. Infrastructure that reduces logistics cost, improves energy reliability, shortens supply chains, raises total factor productivity, alters the future trajectory of the economy. Markets discount the future. If they believe today's deficits buy tomorrow's competitiveness, they tolerate short-term currency weakness or even reward the currency with stability. If they believe deficits by political optics and inefficiency, they exit. This is why two countries can run similar fiscal deficits and experience radically different currency outcomes. China spent trillions on infrastructure over decades. It borrowed heavily, expanded credit aggressively, and tolerated inefficiencies, yet its currencies remained broadly stable. The reason wasn't discipline in the narrow sense, but credibility in productive expansion. Ports connected factories to global markets. Power plants reduced bottlenecks. Logistics corridor compressed time and cost. Exports exploded. Foreign exchange earnings rose faster than import demand over time. The initial pressure on the currency was neutralized by structural transformation. Contrast this with countries where infrastructure spending is poorly targeted, corruptly executed, and politically driven. Projects overrun costs, fail to generate returns, and remain dependent on imported inputs even after completion. There is no export response, no productive surge, no foreign exchange generation. Deficit persists, central banks are pressured to finance them. Inflation rises, capital flees, the currency collapses. The same tool produces opposite outcomes because the underlying state capacity differs. Money supply alone doesn't determine currency value. What matters is relative productivity, relative returns, and relative confidence. A currency is a claim on future output. Infrastructure spending strengthens that claim if only it expands the future output frontier. If it merely shifts demand forward without expanding capacity, it debases the claim. Another overlooked factor is expectations. Currency markets move not on current data but on anticipated trajectories. If investors believe infrastructure spending will improve long term competitiveness, capital inflows can offset current condition deficits. Foreign direct investments increase portfolio stabilization and currency holds or appreciations. If investors believe the spending is unsustainable, pardon, they preemptively exit, causing depreciation even before inflation appears. The currency moves first, inflation follows. This is also a timing problem. Infrastructure spending front loads imports and deficits, while productivity gains materialize slowly. Weak states panic during the interim period. They defend the currency with reserves, impose capital controls, or interfere with monetary policy. These actions signal fragility and accelerate depreciation. Strong states absorb short term pain and allow adjustment. They understand that currency weakness during transition is not failure, it is if it precedes structural gains. Ultimately, the question of whether infrastructure gain devalues a currency is wrongly framed. The correct question is whether the state is converting financial resources into durable command over real resources. Currency strength is a derivative outcome if it reflects whether the state is increasing its ability to produce, trade, and extract value from the global system. If its infrastructure spending is paired with export strategy, industrial policy, energy security, institutional competence, it becomes a currency strengthening mechanism over time. If it is paired with populism, fiscal indiscipline, import dependence, and monetary repression, it becomes a currency destroying mechanism. The difference isn't ideology, it is execution. In the end, currencies do not collapse because government builds roads and ports. They collapse because governments build them without understanding power, sequencing, and constraints. Infrastructure is not inherently inflationary or deflationary. If it is a weapon, it is a weapon. In capable hands, it expands sovereignty and stabilizes the currency. In incompetent hands, it accelerates decline.